Hello, I'm John Duran, and welcome to another episode of the Startup Lantern. We've got a topic today that, while it may not sound like fun, we want you to stick with us. So to start off, picture this. Imagine you've got your prototype ready, you're at the point of considering funding, maybe angel investors, maybe you're already at the Series A stage, and you think to yourself, do I have to give up half my shares to the venture capitalist? Am I selling my shares to them, but maybe the company's getting the money? Well, nope. That's not how it works.
Okay, so like I said, we're starting off from scratch here. A lot of people have a lot of misunderstandings as to exactly how stock works when you're doing a startup. So we're going to start off with some of the basics here. And the first thing that we're going to talk about are the three different structures of corporations that you can have. One of which is the one that you're probably going to want to drive toward if you are planning on doing a startup that is ultimately going to end up getting shares. But the first one is going to be the LLC. So it's my understanding is that you've got some experience with LLCs.
Yeah, so when it comes to LLC, I know a number of friends, a number of folks I've worked with in my past have started LLCs. Their goal was obviously not to create a massive company. They weren't trying to start the next, Google. In many cases, they really were trying to start more of these regional or small independent businesses, and they were using the LLC to protect themselves, to protect their personal assets, and really firewall off that business entity so that they didn't lose their house if it failed. So the LLC was a great way to take care of that and really to set up an organization so that they could safely endeavor into the business world.
The other two types are both types of corporations. One's called an S Corp, and one's called a C Corp. And there's a lot of differences between those two, but we're just going to try to simplify it here a little bit. So I'm going to talk about for a second an S Corp. An S Corp is really, it's kind of a pass-through. And what I mean by pass-through is the company itself, the S Corp itself does not make any profits. They have to take everything, all the money that's coming through. If they're not spending that on the other things that it has to do business with, it can't reinvest anything. It's passing the profits off to the shareholders, which is probably you, and then you're paying tax on it. So in theory, the S Corp isn't supposed to be doing anything that ends up being warranting them having to declare income, from an IRS standpoint. Again, it's also going to be limited in the respect that you can have a maximum of maybe about, I think it's 100 shareholders. It's really meant, more for these smaller organizations. It's got some benefits outside of an LLC from a tax standpoint, but that's what that is.
I think this is kind of interesting. So as S Corp's actually kind of small business. It's funny that just, when you say S Corp, the first thing that comes to mind is just about every evil empire company in every sci-fi movie ever.
Yeah, I think there's that TV show Mr. Robot where they had E Corp as well. That was anyway. It goes into So S Corps are like my wife's a realtor. She's got an S Corp. It's meant more as a tax haven than anything else. It allows you to be creative with some of your income tax. C Corps are the corporations that you look at when you're really thinking about getting investors, splitting up some shares. You can have unlimited numbers of shareholders, and then most importantly is if you're planning on ever going public, a C Corp is really the entity that allows you to do that. You can't go public with an S Corp. So, with an LLC or an S Corp, they may be good for some smaller organizations. But if you're ultimately planning on going to to actually getting funding from either a VC or an angel, the C Corp is really the direction that you're going to want to go. And if you've gone one of the other two directions, they're going to make you restructure to actually be a C Corp by the time they end up going through. So, if you don't choose C Corp to begin with, then you will have to by the time you get to the tail end of an investment.
So at that point, let's step back, Druce. I've started my company. I know I'm planning to go big. I'm planning to have, stock. I'm planning to have investors. I expect that my product is going to make it big someday. Um, how do I begin that process? Because dividing up shares at the beginning, in my understanding, I just assumed that there was a finite number of shares. Like you define your company, you have a finite number of shares, you keep some for yourself, and maybe you sell some to the venture capitalist. Now I'm finding out that's really not how it works. And now that we know we need a C corp, what happens next?
So the first thing is, and I want to take something that you actually just said, that you're never really selling shares to the VC when you end up getting VC funding. But we'll put that aside for a moment. What you're going to do is you're going to start off, and you do start off with a finite number of shares. So I'm going to choose a nice round number and say that we're going to issue 10 million shares, and my pal that started this company, I have a co-founder. He's going to get half, and I'm going to get half. We're going to get equal amounts. So that's the first thing that you want to try to avoid. You don't want to I'm getting 5 million, he's getting 5 million, because you've left no room for anything else at that point in time. You've basically spoken for every single share that you've issued. What you want to do is probably something more in the lines of, he gets a third, I get a third, and then we take a third and we reserve that for a pool of shares that we can use to attract other talent. Because remember, you're doing a startup, you probably aren't going to be making enough to be able to pay him whoever that person is, all that well. So you want to try to attract those people with having some stake in the game as well. So you want to reserve a pool of shares specifically so that you can issue those to other people. So from there, don't worry too much about the fact that you got all these shares are not spoken for. If you turned around miraculously and sold tomorrow, because those shares weren't really issued to anybody, those kind of disappear, and then you and your pal still get half of everything. And now the interesting thing, when you do attract that talent, and you however many shares that you end up giving, sort of offering to them to come on board, you're usually doing that over a vesting scheduled period where it's like over 3 or 4 years. You say you don't get these all up front, so the person can't join and then quit the next day and walk away with all of their shares. So you want to make sure that it vests over a time period, and that way you get to keep them for some period of time. Now, that's how you're going to be treating those other employees. What most people don't realize is, as a founder, you're having to live by that as well. You have to have your shares on a vesting schedule also. So even if you've got that third of the company, like I mentioned when we started off, you don't get that all at once. You're vesting over a time period of 3 or 4 years also. And the reason why you want to do that is, if you're trying to get VC funding, they're not going to want to come in and find out that, again, they can put money into your company and then you can just disappear. They want to make sure that you've got some skin in the game as well. So you're on a vesting schedule, your employees are on a vesting schedule. It's all pretty democratic when it comes to that. You have to stick around if you want to actually get that equity in the company. You've got that, you've got that share. You've got things partialed out. You've got your pool of shares for the potential talent, and now it's time to go out and get funding. Now, what's your company worth? We haven't figured that one out yet. What's your share worth? What is each share worth? We haven't figured that out yet. The share price is always determined when there's some sort of a pricing event. So it's almost like trading your stock, where you don't know what it is until you actually get to the tail end. You open up the box and you find out, oh, my stock was worth $1 a share, or whatever it ends up being. It's the same thing here. You find out what your company's worth and what that share price is when you've had some sort of an event, a pricing event, where you actually find out what that price is. And that's going to end up being, you start talking to some VCs, and there's two figures that end up playing here. There's, what's your company worth, which you are going to be negotiating, and then there's how much money are they putting in. So there are going to be two terms that you end up hearing bantered around here, and that's pre-money valuation and post-money valuation. So pre-money valuation is the the value of the company when you're going out there and you've kind of made that negotiation. Like my company, we've got 10 million shares. My company's worth $10 million, so it's roughly $1 a share, right? Now you're going to the VC and you're talking to them, and they're going to put in $5 million. Now the value of your existing company is 10 million plus 5 million. The post money valuation is the value of your company, the 10 million plus the 5 million that they just gave you. So now your post money valuation is $15 million. And what you've done, because they're giving you've established that your price is $1 a share, and they're putting in $5 million, you're issuing 5 million more shares. So you started off with having 10 million shares at $1 a share, and now you've got an additional 5. You got 15 million outstanding shares, and 5 million of those shares are going to the new VC. They've got a third of the company now as well. Now, the interesting thing is, as I mentioned, they didn't buy those shares for $5 million. They gave you a $5 million loan, and you've given them 5 million shares. So what does that mean? That means that the moment that you sell the company later on down the road, that is a loan that gets paid back. So, say a couple of years later, you end up selling the company. There's 15 million outstanding shares. You take that $5 million that you've done. Say you sell the company for 20 million, you pay back that 5 million to the VC, and then you're left with $15 million that you split out. You got 5 million. Your co-partner has 5 million. Your VC gets 5 million plus the 5 million. So they just walked away with $10 million, and you guys have walked away with $5 million each, or combined, you've walked away with 10 million. They've walked away with 20 million. Even though they only owned a third of the company, they walked away with $10 million from that transaction because you had to pay them back.
So Drew, I mean, the question that seriously comes to my mind is, why would anybody do this? I mean, it sounds so simple, but if I'm going to give away, I feel like I'm printing money for someone else.
And to a degree, you are. But would you prefer to have would you prefer to have $5 million of a company that was worth $20 million, or would you prefer to have zero, like 100% of a company that was worth nothing? You're getting this funding because it's allowing you to do something. It's allowing you to take that next step. It's allowing you to grow. And when you're doing a startup, timing is everything, and nothing allows you to trade in time for anything like money. You can trade money for time. So if you can get that round of funding, the hope is that it's going to be worthwhile for everybody. Now, if you can go to a bank and borrow 5 million, that's great. But in general, we're talking about transactions here that your average bank is not going to want to just lend you $5 million with a 10% interest. The VCs are, they're not charging you interest. Their interest is the stock. They're lending you $5 million. You're going to pay them back that $5 million. But what they're getting in exchange for whatever the interest rate is, they're getting the shares as that interest payment. So they're taking a gamble on you. If your company goes under, they don't get anything. So they're taking a higher risk than a bank would, but they're also going to be profiting a lot more. This is why it's good to be a VC. It's you get to, this entire process is a term that the insiders call double dipping. They get to get their payback, and then they also get to take advantage of the valuation. This goes back to one of the things I said at the start of this process, which was, this is good to know, even if you're not a founder, even if you aren't a startup yourself. If you're thinking about joining a startup, it's going to give you a little bit of an idea as to whether or not there's a possibility of a good outcome. If because you can go to you can go to a site like Crunchbase and see how much money all these different VCs have put into an organization, and you can add all those things up and know that those things are markers. Those are, you have to pay all that back. So you add all the funding that they got together, and you say, boy, do you think that this company is going to be able to sell for that? Because if they sold for just that, then the company's worth nothing. Like the VCs get paid back and there's no positive outcome. A company is going to end up having to be worth 3, 4, 5 times the amount of money that they've taken in, as VC funding for it to be worthwhile for anybody with shares. So even if you're not planning on starting your own company, if you're an employee looking to come on board and that stock is looking good, you got to kind of look into the future to try to see, is this stock actually going to be worth anything going forward? Because that's the only time it's actually worthwhile doing.
So a couple of thoughts there. One is just that the first thing that comes to mind is the old statement, you've got to have money to make money. And I think, joking aside, that's where the VCs really come in. The goal here is I need money to turn this into a real idea, into a real company. The vision is long term, maybe to sell it or et cetera. That's why the VC market exists. And then secondly, what I'm hearing here also, if my company needs to be worth at least 2, 3, or 4 times what the stocks I have, I think that probably also plays pretty heavily in setting that initial number of stocks, how much you borrow from the venture capitalists, because they're not going to loan you as much money as you think the company will be in 3 or 4 years. Obviously there would be no payback for them at that point. So, you need the VCs if you really want the company. If you need that influx of cash, the funding to drive the company, the VCs are there for that. And you're not selling shares to the VC.
No, but you've actually got a good point, and that's really like one of the bigger mistakes that you see startups make when they come on board here is they're looking for just like who's going to lend, who's going to give them that money, and there's so much more that a VC can end up earning. And if you're thinking about their only value as being that they're going to be able to come by and they're going to be able to give you that money, it's kind of sad because they can offer a lot more. And one of the biggest things, get ready for the cue up of the image here. They're sharks, but if they have invested in you, they're your sharks. So they can kick open doors for you that you wouldn't be able to kick open on your own. They've got I've seen a lot of really the better VCs that are out there. Will end up being really invested in your success because obviously your success is their success. So they're going to make introductions. They're going to help you with different things. They're going to help make your company more successful. And if all that you're getting out of them is that money, you're leaving some things on the table. So this is why it's also good to be in a position of strength where you can actually be picky about who actually invests in you, so you can get somebody who is going to end up helping you be successful in the long run. It's what they call smart money. You want that smart money. You want somebody who's going to be able to come in. And like I said, aside from them giving you lots of money and aside from them getting a portion of your stock, they're probably going to want that board seat as well. And again, that's not necessarily a bad thing because they're going to know the pitfalls and they're going to be able to advise you of the things to avoid. But again, they're going to help you be successful. In the end here, there are lots of different ways to structure a company like this. We mentioned, one of the more common ones, especially when you're dealing with Silicon Valley area startups. But this isn't the only way. So remember, we're not attorneys. We've been through this a couple of times. But if you're going to go through this process, this is where a good attorney is going to help you navigate all these different ins and outs. Your mileage may vary. You may end up getting completely different terms than what we've described here. But this is just a very common way that you would experience this if you're going in through this. Talk to your attorneys. Make sure that you've got all this stuff settled.
Yeah, thanks for joining us for another episode of the Startup Lantern. We look forward to talking with you again real soon. We have a whole list of topics lined up. Please join us, subscribe. We encourage you to add your comments and thoughts in the forums associated with the video. We'd love to hear some of the challenges that you're facing, some of the things that may be preventing you from starting your own startup company, because we want to address those topics. We want to help you achieve some of the things that Drews and I have done in our lives because they are so life-changing. You'll learn so much about business and they'll change the way you look at business for the rest of your life. So thanks again for joining. We look forward to seeing you on the next episode of the Startup Lantern.